All right. Welcome, everyone. Thanks again for joining us. I really appreciate everybody taking some time out of their busy day. We really know how busy you guys are, so we appreciate it and promise to make this time worth your while. First off, a couple notes. This webinar is being recorded, so if you have to jump off early, we will send you a copy of the webinar to your email after we're done. We'll also be fielding questions at the end, but feel free to chat in any questions that you have along the way. My name is Devin Turner. I'm with TCG Advisors here, and I'm going to be the moderator for today's webinar. We have a bunch of good information slated for you all, just like I said, from our sister company, Taylor Advisors, and our favorite credit union, Firstmark Credit Union. I'm going to go ahead and introduce our presenters today. We've got Taylor Advisors. They're a frequent thought leader for the community of financial industry. They consult on about $75 billion of community financial assets, $50 billion for the U.S. Department of Energy, and advise on about $13 billion of investments for community financial institutions. Our speaker today, Omar Hinosa, is a managing partner at Hub Taylor Advisors and works with financial institutions from across the country to provide balance sheet and risk management solutions. He's been a frequent speaker at various financial institution programs that include the Federal Home Loan Bank System and Bank Director Magazine. Omar has banking, investment, and private equity experience, so it's only natural that he holds the Chartered Financial Analyst designation and is a current member of the CFA Society. Wrapping up our discussion today will be Mike Grundon, Chief Financial Officer of Firstmark Credit Union. He first joined Firstmark in 2016 as a member of the senior executive team and now oversees the credit union's financial operations. With 33 years of experience in financial services and over 23 years in the credit union industry, his expertise is matched by very few, so it's no wonder that he's been active with multiple industry organizations, including the Credit Union National Association and the Credit Union Executive Society, speaking on topics such as asset and liability management, profitability, and data mining. Now, I know that was a lot, but without further ado, I'm going to go ahead and pass the virtual mic over to Omar to talk about the data that they're seeing over at Taylor Advisors.
Great. Thank you. I appreciate that. Again, as we take a look at the topics of discussion, a couple of items that are key on everyone's mind is this whole idea of inflation. So we're going to talk about prices going up on homes, autos, and a variety of other areas. And just as well as, interest rates continue to move higher. It's something that we see in the news quite a bit, as well as in commercials, as the Federal Reserve raises interest rates, which is increasing borrowing costs. So we're going to talk a little bit about why that's happening and how that impacts consumer sentiment, as well as how that is designed to help manage inflation and kind of manage these boom scenarios and ups and downs in the market. And lastly, the whole idea here is just, as you think about the current environment, we want to share a couple ideas and things that you should be aware of that can kind of help you navigate, these waters as we kind of, move through the next several, what will be 18 to 24 months. So as we take a look over at the next slide, as we pull data from the Federal Reserve System, is you're looking at a series of charts. And the first one is looking at home prices. That's the top blue line. The middle red line is going to be the cost of used autos. And the purple line is going to be oil prices. You're going to see some gray shaded areas. And over that time, and what that indicates is these are times of what they technically say are economic recessions. So one thing that you'll notice is on the far right-hand side is that they're all going up. And they're all going up at a very quick pace. So you can see the gray line there next to 2020. That was the self-imposed recession as a result of the pandemic and the lockdowns, et cetera. And with that, a lot of cash flooded the system through stimulus payments, as well as low borrowing costs and other measures, which are pushing rates higher all across the board, and as well as prices as well. So all these rising prices, what that means for us is that the value of the US dollar relative to cars, right, relative to homes, relative to even gasoline is changing. And as a result, that is what's pushing them higher. And that is what we call inflation. So if we go to the next page, and take a look at this chart, and what you're looking at here is, I know there's a lot of jagged blue lines moving up and down. And essentially what that is that is the measurement of the consumer price index, right? That the change at which the cost of homes, the cost of groceries, the cost of gasoline, the cost of autos are changing from one month to the next. So the dotted red lines, that's just our way of trying to smooth out those jagged lines so that you can see trends over time. And you'll notice that if you take a look at the far right-hand side of the chart, it's very high. It's almost as high as 6.5% and 7%. That's an inflation rate that we haven't seen since the early 80s. You know, so you think back of what was taking place back in the 80s. You know, we had Prince that was pretty big, right? You had Miami Vice, you know, Madonna, and heck, even Prince William was just born. So you fast forward to today and you take a look at where we are. Well, Prince William is still in the newspapers. However, he's quite a bit older now. I mean, he's 40 years old. And so for most of us on this call, you know, we can't really remember a time when we experienced this type of inflation. And for those of us that can remember, it seems, you know, quite some time ago. So a lot has changed in our economy and how we live. But one thing that is reemerging is this cost of goods increasing. And we're going to unpack why is it that we're seeing interest rates change as a result of these inflationary pressures. So the next page. Again, going back to those dotted lines that you saw earlier and those blue jagged lines, again, that's the inflation rate. So if you notice that the new line that we've added in is this orange line, and this is the prime borrowing rate that the Federal Reserve sets for the banking system. So you'll notice that in times when you look at that those red dots and the orange line, they pretty much move pretty close together. Right? So as the red dots move higher, i.e. inflation is increasing, the Federal Reserve starts to raise borrowing costs and raise interest rates. And then as those inflation begins to move downward, the Federal Reserve lowers those borrowing costs and lowers those interest rates. And so up and down the cycle goes, you know, in this chart looking from 1983 all the way out to the current time period. Again, going back to those recessionary periods, is as rates move higher, the Federal Reserve is purposely trying to slow the economy down. And sometimes they overshoot this. And as a result, we get these economic recessions. And so, you know, we are in an environment where the Federal Reserve is raising interest rates once again as a way to slow down the rate of inflation and slow down this hot economy that we're experiencing. So only time will tell as to whether or not we get a recession, you know, over the next 12 to 24 months. So let's go to the next page. Now, we talked about the bank borrowing rate, which is that orange line you looked at earlier. And then we added in rates for borrowing on mortgages. And that's the green line, you know, 30-year mortgage, as well as, you know, borrowing for auto loans, you know, at a 4-year kind of term. And again, they all move very close together. So, you know, as you're hearing interest rates going up, you're just always think in the bottom of your mind, that in the back of your mind, I apologize, is that, you know, the Federal Reserve is trying to slow the economy down. They're trying to slow the inflation rate from going higher and higher as a way to keep our economy stable so that consumers, you know, across our country don't feel such large shocks when it comes to increases in commodity prices or, you know, holding off from purchasing a home because they just continue to move higher and higher and higher. So as we take a look at the next page, going back to these recessionary periods, and we talked about that prime borrowing rate, I've now changed that orange line to blue. Now, the new green line that you're looking at is consumer sentiment. And so essentially what it is that there's a survey that goes around throughout the country, and they ask individuals at homes, how do you feel about the economy? How do you feel about purchasing more goods and so forth? And what you'll notice is that, as you look mainly in the middle of the page, is that every time we have these booms, right? We think about the late 90s during the dot-com boom. Notice how consumer sentiment was very high, a lot of energy, a lot of excitement around the dot-com. There were lots of news headlines about new companies coming out, that were increasing in value quite a bit. And notice how that blue line moves up along with it as the economy continues to gain steam again, and at a very rapid pace. The interest rates move higher, we enter a recession, and then we move on into the 2005, 6, and 7 time period, which I kind of referred to as the HGTV, boom. All of us were mostly sitting at home, watching all these new shows coming on about flipping homes or, renting, creating rental properties and so forth. And so there was this euphoria, again, in the market, in the housing market of individuals that, buying a second home and flipping it and so forth. And again, interest rates moved up, mortgage rates moved up, all those rates moved up in an attempt to kind of slow down the euphoria. And then we ended up in a recessionary period, which you saw thereafter. Now, when you look at what happened since the Great Recession, remember, as interest rates dropped, notice how when they floored out, that green line started to move up again. As the consumer sentiment started to get better, we started to feel better about our balance sheets and our excitement. And then the cryptocurrencies, came into play, and that essentially was attracting a lot of investment from individuals, because you didn't have to buy one full Bitcoin. You could buy pieces of Bitcoin and so forth and other cryptocurrencies. Then we get hit with the pandemic. And then as interest rates moved up, we get hit with the pandemic and rates come down again. And so what we're going to do is we're going to shift now that we can see how sentiment moves up and moves down as interest rates move up and move down. Now we're transitioning over into what is it that's happening personally to us, and what's impacting that sentiment. So back to that green line. I know it's moving up, it's moving down, it's typically moving higher right before you get to a recession. But notice the new red line. And the new red line is household financial obligations. So what this is indicating is, the amount of disposable income that is being used to service debt payments, whether that be buying a bigger house in better times, whether it takes on, a larger mortgage, whether that's, taking perhaps maybe more elaborate vacations, et cetera, drawing on credit cards as well, as we gain confidence. And so what you'll see here is that during these times where our sentiment is good, we feel confident in the future. And so as a result, we as a society are more likely to accumulate debt. But that debt, obviously, it gets to a certain point where our cash flow changes, mainly because we're spending more of our free cash flow on making those credit card payments, right? Making those auto payments, making those other financial obligations that we have. And then as a result, we start to tighten up our belts again because we realize that it's unsustainable and we start to pull back. And so that's why you see the sentiment dropping during those recessionary periods. And then with the exception of what happened during the HGTV boom, when there was lots of financial obligations continue to move higher because households were buying second properties to flip, etc., that it pushed up to some pretty high levels. Then as you migrate through 2010 and to the right of the chart, notice how those financial obligations came down. And there is a reason that all these came down. And the primary reason is that, remember, interest rates go down during recessionary periods. And so when interest rates go down, that 5.5% mortgage that we took out in, say, 2007, we get to refinance that mortgage, and we get to refinance it down to 3.25%, and so as a result, those monthly payments that we're making drops. And so that frees up cash flow on our balance sheet, or on our, from our income minus our expenses. And so we're able to, again, be more confident because we have more money left over after making our loan payments and other financial obligations. And then the cycle starts all over again, which you can see kind of going through 2012 all the way through 2013. So as interest rates go higher, the amount of debt service payments goes higher as well, because on the floating rate side from credit cards, that interest payment goes up. As maybe we're feeling good about the economy, and so maybe we look to move, sell our old home, move into a larger home at a more expensive price. Those payments go up and at higher interest rates. And then as we start to get perhaps maybe a little stretched financially, we start to pare back. The sentiment begins to decline. And as a result, interest rates go down as the Federal Reserve's way of providing relief to households, again, to be able to maintain that. So now let's kind of shift over into the other side. So we talked a lot about, debt and the accumulation of debt, during good times, but also at the same time, when borrowing costs are higher, so are savings costs. And so what you're looking at here on this chart is the 3-month Treasury bill. And so we kind of use this as like a de facto benchmark for savings rates. And so you'll notice that they go up right before recessionary periods too. They go down following the recessionary periods, and they move pretty close to those same borrowing rates. So even though rates are going higher, and it costs more to borrow money, it actually favors savers in a rising rate environment. And that's exactly what we are moving into today. So let's go to the next page. And this is a very interesting table. And this is probably one that I really like to look at, because it helps to get into the behaviors of individuals and households as we move through these market cycles. So if you take a look over at the left side, and you go back and you can look at those charts from consumer sentiment and how it moved up and it moved down in lockstep with those interest rates, as well as those recessions in between. So coming out of recessions, and you think about consumer sentiment moving higher, you think about the economy doing better, you think about it, us, borrowing more money or buying a bigger house, there's optimism, there's excitement, there's a thrill. Eventually we get to this euphoria. Think of the home flipping, the HGTV boom. And then we start to think that this can go on forever. And then things change, right? We start to see less free cash flow because we're taking on more debt, and it does get more expensive. So then we start to pare back, and you start to see the anxiety, the denial, the fear as the economy starts to slow down, as we maybe overextended ourselves. And I'm talking in broad terms related to the entire US population. And then we start to move to these downward periods, which are, i.e., the economic recessionary periods. There's frustration, maybe there's some depression in this case, and then hope starts to return as we start to see interest rates come down. We refinance our our higher interest rate debts into lower interest rate loans. And as a result, we get that free cash flow and we start to feel hopeful and optimistic again. And the cycle starts all over and all over again. So when you think about your own, situation and kind of where you are, it's always good to kind of think about it from the behavioral standpoint, because ultimately that's what drives finance. So when rates are higher, and which is the environment that we're moving into, our cost of borrowing is higher, but remember, our savings rates that we get paid on interest are a lot higher too. So we want to take advantage of those higher savings rates and earn more interest on our cash. And then as the rates go back down, that's when we probably want to look at maybe borrowing, because we would be more favorable. We're probably going to have more savings, better cash reserves, etc., which further would help you and I talk in, again, general terms to the whole US population, to be able to borrow at more favorable rates, again, as we kind of move through the cycle and it restarts all over again. So let's kind of shift to some key takeaways from today's discussion. So number one, the inflation is at the highest level that we've seen since the early 1980s. And what's populated part of this is we've had lots of large fiscal stimulus during the pandemic. As you think about the PPP loans, the Payment Protection Lending Program, which most of those loans were forgiven. So they were almost a grant, if you will, to businesses. You think about the economic injury disaster loans. These were low interest rate loans with very long payback periods that were offered to businesses to help them maintain their solvency, as well as continue to pay their employees through the pandemic. You got the economic relief for municipalities. There was additional funds that went to our cities and went to our counties and to our school districts, again, to help kind of supplement, the shock to the system that we had as a result of the pandemic. We have special unemployment checks, both from federal and state, that were also injected into the system as individuals were forced to work from home or not work at all if the virtual option was not available to you. Tax credits, there's been cancellation of student debts on a selective basis, as well as deferment on student loans and mortgages and rents. All those different things increase demand for consumption, because this is extra money coming into our accounts, either through the federal government, or it is a reduction in the amount of debt payments that we have. All that leads to more deposits and more appetite to fuel demand to make purchases during this time frame. Just as well as you think about the supply side, right, is that we've seen lots of logistic disruptions from reducing supply of goods. The global lockdowns, we've heard that over and over again, that there is a huge delay in getting pretty much anything. We're located here in Louisville, Kentucky, where there is a huge Ford plant, and they were producing vehicles and they were delivering them into empty parking lots because they couldn't sell the vehicles because they were waiting on a specific chip to come from overseas that they were short on. So again, less supply, more demand. That is the perfect recipe for higher interest rates, higher inflation, just as well as we have a labor shortage and in other areas too. And as well as the war in Ukraine is putting upward pressure on gasoline and other energy prices, and even some commodities for that matter. So on the next slide, is you kind of think about next steps, again, always remember that as interest rates go higher, this is purposefully done by the Federal Reserve to slow down this increase in the cost of our goods. Perhaps to slow down the demand side by making it less desirable to borrow money or borrow funds, because we're paying a much higher interest rate on it than we were, say, 6 months ago. Just as well as on those higher interest rates, they typically mean higher financial obligations. So as you kind of go back to the presentation earlier and looking at all those charts, remember, as interest rates went higher, those financial obligations went higher too. So that means higher monthly payments and less available to save and spend on consumption. And ultimately that starts to, again, slow down the demand side so that it can be more in line with the lack of supply that we have today. So in this current environment, just be mindful that, debt accumulation, that be mindful of accumulating more debt when interest rates are higher, right? As we think about it, is it something that we have to, acquire or do or so forth, and maybe, save that for another time when interest rates are lower. And also if we're accumulating less debt and with that, that's resulting in more free cash flow, take advantage of higher interest rates for saving. As you kind of think about the Firstmark or any other savings rates, they're a lot higher today than they were at the beginning of the year. And so we should be looking to take advantage of that to maximize our earning potential from the environment that we're moving into over the next, 12 months or so. So with that kind of completes my section related to kind of this, the broad discussion around inflation, interest rates, how that impacts financial obligations for all of us on the call, as well as how does that impact the economy, over time, and to know that it's by design. So, so with that, I'm going to hand it over to Mike, and he's going to talk a little bit about, how the credit union can help its members, through this time as well.
Thank you, Omar. Great overview. Appreciate you explaining that to all the participants on the call today. Just one thought as I was listening to you. Obviously, the key with inflation is at the end of the day, consumers get an erosion of their wealth, so to speak. As goods become more and more expensive, it takes more and more dollars to buy those goods. And obviously, as we look moving forward, as interest rates go higher, the Fed is weighing, the depreciation if you will, in purchasing power of the American consumer versus what interest rates will do to the economy. And it's a tough balancing act. A couple of things I just wanted to share with you all today. Certainly when interest rates are lower, we know that tends to favor members with lending requirements. Of course, big purchases like automobiles and homes are far less in debt service coverage if interest rates are lower. If we can move to the next slide, please. And obviously when interest rates are higher, that does tend to favor savers. I've got some examples of just promotional certificates of deposit we have today here at the credit union. One thing to consider in the volatility that we have seen in the market over the last 6 months or so. Certainly, we've all seen the stock market. It's been a bit of a roller coaster ride without getting into too much of the details. Omar, I think, talked about some of the inflection points and why it's changing. One thing that we provide to you here at the credit union is safety and soundness of principal. So when you do put your money into, say, certificates of deposit here at the credit union, you can count on the credit union being able to repay your principal and being here for the future. So these are our current promotional CD rates. Interest rates obviously are changing on a daily basis. We will continue to monitor that, and we will provide the membership with opportunities for higher savings. Devin, I believe that concludes my remarks.
Awesome, Mike. Well, appreciate you wrapping that up for us. And I know that everybody here on the call, I think, has been pretty captivated by all the information that we've kind of shared here today. I know I found it extremely interesting and learned a couple of things myself. So this is just something that we plan on doing going forward, with all Firstmark Credit Union members, and with the partnerships going on between TCG and Firstmark, and wanting to make sure that we deliver high quality, education and topics for you guys. And, if you have any questions, or if there's anything else that you'd like us to cover here in the coming months as we look towards the end of this year, we're definitely open and here for suggestions on that. I want to make sure that we're giving you guys everything you need. And I know we have a couple of questions rolling in here, but they do seem to be a little bit more specific to people's personal situations. So we will have our team of fiduciary advisors reach out to everybody here, as well as send you a replay and recording of the webinar today. So if you have any questions, want to follow up, talk about your specific situation, you can do so by going to the QR code there, that website URL right below it, or just simply replying to the webinar replay that we will email to you all this afternoon. So with that, I want to go ahead and thank our speakers, Omar and Mike, again for taking the time out today to chat with all of us, and we hope to see everybody on the next one.